We've got Vivek Rajpal, who's a rate strategist at Nomura India, now joining us on the show. Vivek, to begin with, we've had the June inflation number come out, and we're seeing the market somewhere, cheering the numbers on the expectation that you'll see rate action from the RBI sooner than expected. What's your view?
Our view is that RBI will probably not cut rates on 31st of July because Dr. Subba Rao made a very strong case for not cutting rates on 31st of July. But having said that, it is increasingly becoming clear that we are in the midst of a rate cut cycle. So from market's perspective, probably other than the very front end, which is highly dependent on the overnight rates, which is dependent on the repo rate, the rest of the yield curve is expected to come down. So overall, I would say today's inflation reading confirms that we are in the midst of rate cut cycle. However, 31st July, it still looks not so sure.
Sure. So, Vivek, how do you believe the bond markets will read into the fact if we see a pause, as you're saying, from the RBI on the 31st of this month?
So, bond markets, I mean, if you really see, bond markets the bond market at the moment can be divided into two parts: the older securities and the newer securities. The older securities were anyways rallying, and it's just that after today's move, after today's inflation print, newer securities have found a rally, to say so. Because especially after today's headline inflation, once it gets confirmed that at some point of time we will get a cut, naturally the belly of the yield curve or the back end of the yield curve, which is 10-year, etc., will price in the forward expectation of rate cuts.
You had the bond markets which were also hinging on the fact that there would be a bit of a recovery in the monsoon for the month of July, but now we just had reports from the meteorological department that it may miss the forecast. So how do you believe the bond yields are likely to move on the back of this?
So basically, this is exactly the fear why bond markets were not rallying substantially if you compared it with swaps market. The fear was that that in the food prices we will see an uptick. However, what we saw in the June inflation print was that the food remained benign, in the sense that it remained at 9%. Yes, in future we may see these prices giving an uptick on the food inflation. If RBI doesn't cut rates, if we get an upside surprise on food inflation in the next reading, bond markets may give up some of their gains.
And finally, Vivek, what would your view be on the rupee, given that it's currently at close to 55 against the US dollar?
So our view has been pretty much the same. We think 53-54 is a fair value zone for the rupee, and we may see a gradual appreciation from the current levels. It is very likely that the worst in terms of current account worst is kind of behind us, and from here on, owing to lower oil prices, owing to a better current account deficit trajectory, we may see a very gradual appreciation of rupee from the current levels.